Remember the 90s in the Philippines? It felt like a time of incredible optimism. We were dubbed the Tiger Cub economy, growing faster than we had in decades. Construction was booming, foreign money was pouring in, and for many, the future looked bright. The peso was stable at around 26 to the US dollar. But then, in 1997, the party came to a crashing halt. What happened? How did we go from economic darling to a nation in crisis, seemingly overnight? This is the story of the 1997 Asian financial crisis and how it brought the Philippine peso to its knees. To understand what happened to the Philippines, we first need to look at our neighbor Thailand. In the early 90s, much of Southeast Asia, including Thailand and the Philippines, pegged their currencies to the US dollar. This meant our central banks promised to keep the exchange rate stable. For the Philippine peso, it was locked at about 26 pesos for every dollar. This stability attracted a flood of foreign investment, especially short-term loans called hot money. Investors would borrow dollars at low interest rates, convert them to Thai baht or Philippine pesos, and invest in our booming stock markets and real estate, making a quick profit. It was a great deal, but it was built on a shaky foundation. These countries were taking on massive amounts of foreign debt, often for speculative real estate projects rather than productive industries. In Thailand, this created a massive property bubble. There were shiny new office buildings with no tenants and luxury condos with no buyers. It was a ticking time bomb. International investors and currency speculators, like the famous George Soros, saw the writing on the wall. They realized the Thai baht was overvalued and that the country's debts were unsustainable. So, they started to attack the baht. Here's how it works. Speculators would borrow huge amounts of baht from Thai banks. Then, they'd immediately sell those baht for US dollars. They were betting that the baht's value would eventually fall. This massive sell-off put immense pressure on Thailand's central bank. To maintain the peg, the bank had to buy all the unwanted baht using its own US dollar reserves. It was like trying to plug a dam with your finger. They spent billions, but the selling pressure was just too strong. On July 2, 1997, Thailand surrendered. They ran out of foreign reserves and were forced to unpeg the baht, letting its value float freely on the market. The result was catastrophic. The baht immediately plummeted, losing over half its value in a matter of months. This was the shot heard round the region. The panic was contagious. International investors looked around and asked, if Thailand is in trouble, who's next? Their eyes turned to other Southeast Asian economies with similar problems: large foreign debts, weak banking systems, and pegged currencies. Countries like Indonesia, Malaysia, South Korea, and of course the Philippines. The contagion hit the Philippines almost instantly. Speculators who had just made a fortune betting against the baht turned their attention to the peso. They used the exact same playbook: borrow pesos, sell them for dollars, and wait for the currency to drop. The Bangko Sentral ng Pilipinas, our central bank, tried to defend the peso, just like Thailand did. They raised interest rates to insane levels, making it more expensive to borrow pesos and speculate. They also spent over $1 billion of our foreign reserves buying up pesos to support its value. But it was a losing battle. The speculative pressure was too intense, and the panic had already set in. Just 9 days after Thailand floated the baht, on July 11, 1997, the Philippines had no choice but to do the same. The BSP let the peso float. Just like the baht, it went into a free fall. Before the crisis, you needed 26 pesos to buy $1. By the end of 1997, you needed 40. At its worst point in the coming years, it would even touch 56. Our currency had lost nearly 40% of its value in less than 6 months. So what did this mean for the average Filipino? It was devastating. Imagine the price of almost everything you buy suddenly shooting up. Why? Because the Philippines imports so many essential goods, from oil and raw materials for factories to components for electronics. All of these are paid for in US dollars. When the peso collapsed, the cost of importing these goods skyrocketed. Fuel prices soared, which in turn drove up the cost of transportation and basic commodities. The price of bread, rice, and canned goods went up. Suddenly, every family's budget was stretched to its breaking point. Inflation surged, eating away at people's savings. The crisis also triggered a wave of corporate bankruptcies and job losses. Many Filipino companies had taken out loans in US dollars back when the exchange rate was stable. When the peso plunged, their dollar-denominated debts effectively doubled overnight in peso terms. A company that owed $1 million, which was 26 million pesos, suddenly owed 40 million pesos, even though their income was still in the now weaker currency. Many couldn't pay. Businesses shut down, construction projects were abandoned, and thousands of Filipinos lost their jobs. The unemployment rate jumped, and the economic growth we were so proud of vanished, replaced by recession. But there was one group that saw a silver lining, at least on the surface: overseas Filipino workers, or OFWs, and their families. Their dollar remittances were suddenly worth much more in pesos. $100 remittance that used to be 2,600 pesos was now 4,000 pesos. For these families, it was a sudden increase in purchasing power and a crucial lifeline during a time of intense economic hardship. This highlighted just how important OFW remittances were, and still are, to the Philippine economy, acting as a buffer during times of crisis. However, even they weren't immune. Many OFWs were working in other Asian countries that were also hit by the crisis, and some faced job losses or pay cuts themselves. So what did we learn from this painful episode? The 1997 crisis was a brutal wake-up call. It exposed the dangers of relying too much on short-term foreign loans, or hot money. It taught us the importance of having a strong, well-regulated banking sector to prevent reckless lending. In the aftermath, the Philippines and other affected countries implemented major reforms. We moved away from a fixed exchange rate to a more flexible one, which can act as a shock absorber. Central banks became more transparent, and we built up our foreign reserves to better defend against speculative attacks. We became more cautious about foreign debt. These reforms made our economy more resilient. When the 2008 global financial crisis hit, Asia, including the Philippines, was much better prepared and weathered the storm far better than the West. But did we learn all the lessons? Some argue we're still vulnerable, still rely heavily on OFW remittances and the BPO sector, which are dependent on the health of other countries' economies. And inequality, which was worsened by the crisis, remains a huge challenge. The wealthy could protect their assets, while the poor bore the brunt of inflation and job losses. The 1997 peso collapse is a critical chapter in our recent history. It shows how interconnected the global economy is and how quickly things can change. It was a story of financial speculation, economic missteps, and widespread panic. But it was also a story of resilience, reform, and the enduring strength of the Filipino people and the families who support them from across the globe. Remembering it helps us understand the economic landscape we live in today and the importance of remaining vigilant. Thanks for watching. If you found this deep dive into our economic history interesting, please hit the like button, subscribe to the channel, and ring that notification bell so you don't miss our next video. What are your memories of the 1997 crisis? Share your stories in the comments below. I'll see you next time.